We're gonna go ahead and get this stuff kicked off, guys. Get this thing rocking and rolling. Uh, so again tonight, guys, we're gonna be going live on chapter 2. This is gonna be going over all the nuts and things you need to know about life insurance policies in general, and what's the word? And annuities. So this is going to be a very in-depth chapter. It's going to be a lot of terminology, a lot of different examples. Again, we're going to keep this simple enough to where it will give you everything you need to know in order to pass this exam, guys. So as we get this stuff kicked off, again, make sure that your camera's on, muted if you have a lot of noise in the background for the sake of this recording. We want to make sure that we have a good audio to this. Okay. Perfect. So let's go ahead and get this part kicked off this evening. So again, we're going to be covering chapter 2. Chapter 2 is going to be going over. If you have a lot of noise in the background for the sake of this recording, we want to make sure that we have there goes YouTube want to go start talking while I'm going. If you guys have questions, put them in the chat. I'll make sure I touch bases on these. So this is chapter 2. We're going to be covering life insurance, types of policies, different verbiage, everything you need to know to pass this exam. So let's go on into some of the definitions that we're going to cover. Again, make sure you're taking notes. So let's talk about what does it mean to have life insurance when you're getting it. There's certain things that life insurance companies look at, and these are some of the definitions you're going to need to know. The word attained age. This is when the person buys life insurance at the policy. This is the time when they are applying for the coverage. So in the mode of when we're looking at life insurance in general, the word attained age is the age that when they are applying for the policy or they're having to renew the policy. Cash value. This is a person's savings or the living benefit in a policy. You guys know we see a lot of stuff on social media about life insurance being marketed as a savings vehicle, which I'll break all that stuff down into detail. What does the word face amount mean, Stephanie? Stephanie, this means this is the amount of money that's going to get paid out. When you see the word face amount, I want you to write the word death benefit to it. Death benefit and face amount meaning the exact same thing. Now, when you see the word deferred, the word deferred is to postpone until a specified time or event in the future. When you see the word deferred, they're going to be meaning when can you receive the money. That's the only time you're going to, when you see the word deferred, think of, okay, this is when I'm going to be able to receive the money. When you say the word to endow, this is the cash value of a whole life policy that has reached contractual face amount. The word endow means this. Write the word to mature. A whole life policy, the cash value, it will mature at age 100. I want you to write all that together. The word endow, to mature, and it is at age 100. I'm going to go more into detail what that means. Just kind of take notes on that. Level premium. The premium that does not change throughout the face amount or throughout the life of the policy. When you see the word level, that just means the payment stays the same. But I also want you to write the word level. I want you to write the word straight premium, the exact same thing. Straight level premium. Right? No, not straight premium. Just write the word level premium and then / straight. Because that's going to come up in whole life insurance. That's going to define how the premiums are paid. Okay, so let's talk about liquidation of an estate, converting a person's net worth into cash flow. If you're going to write that down, liquidation of an estate, that's an annuity product. So if you're going to write that down, liquidation of an estate, this is when you're going to take their money that they have and turn that into cash flow, and that's generally used through an annuity product. Non-forfeiture options or non-forfeiture values. Okay, this can sometimes confuse people. And the next chapter, I'm going to really break that down in the detail. But what is this? These are the benefits of a whole life policy that the policy owner cannot lose in the event of the policy surrendered. So write non-forfeiture values, and right next to that, write cash value options. This is what you're able to do with the cash value you've built in a policy. So non-forfeiture options, again, these are the benefits you can use from a life insurance policy. Next to that, write cash value options of what you can do with the money. Let's talk about policy maturity. In life insurance policies, the time when the face amount is paid out. Okay, so you heard me use the word maturity over here during endowment, right? Policy maturity, I want you to write whole life insurance at age 100. Policy maturity at age 100. You're going to start to see these themes start to repeat themselves. And when you see the word security, financial instruments that may trade a value, example, stocks, bonds. When you see the word securities, I want you to write the word investments. Anytime you see something pop up with securities, I want you to think, okay, that's an investment product. I need to have my investment license for that. Any questions on this part so far? Feel free to unmute yourself if I went too fast or if I confused you on any of that. Nope. Okay, perfect. Let's go through the next part of this, right? So now we're going to cover term insurance. When you're going to write the word term insurance, Sebastian, you're going to write the word temporary protection. Term insurance, temporary protection, and this only lasts for a period of time. So you're going to write coverage is, it provides coverage for a period of time. And next to term insurance, I want you to write the word no cash value in like big bold letters, no cash value. Term insurance does not create any kind of cash value. And then another bullet point under term insurance, I want you to write it provides the greatest amount of coverage for the lowest premium. So you're going to get more coverage for less money per month. When you write that, when you think of whole life, insurance in general, term insurance is the most cost-effective one. You get more coverage for less premium a month. Now, term insurance does max out at a certain age. You can't get term insurance after a certain age. Every insurance company is different. So just understand you can't get term insurance generally on an 80-year-old or a 90-year-old. There are insurance companies that offer what is called guaranteed renewable policies. So if you have the policy prior, you can renew the coverage all the way until they're generally about 100, but that's going to be your most expensive version of that, right? So during term insurance, I want you to write the word pure death protection. And big, bold. Anything in bold, you should look at it. Bold. One thing that you should look at about term insurance and the industry overall, out of all life insurance policies, only about 2% of all death protection is actually term insurance. Which means when you write a policy on somebody, the chances of them outliving the policy is actually high, which is good because you want your clients to live. This is why you want to get them as much coverage as possible for as little as possible so that they can overfund their actual retirement accounts. So some people ask me, well, why should I buy term insurance? Because there's no cash value. Why would I buy term insurance? Term insurance Katya, is I always like to relate it right back to your car insurance. It's protection you pay for the period of time that you need it. If you 80 years old, you 90 years old, you're not going to be paying for car insurance because your ass ain't driving no more. And if you are, congratulations. I do know some old people that's still driving. That's why our car insurance rates in Florida so daggum high. Then you got 18-year-olds like Sebastian getting on the road, and you're like, dang, I understand about having insurance. No. So life insurance, term insurance is just pure like car insurance. You pay for it. If you don't need it, cancel it. Another thing about term insurance is that it does expire. And so when generally someone goes to renew their policy, you can expect the premiums when they're older to probably go 3 or 4 times the amount, like double, triple, quadruple in price. Which is why some people say, well, term insurance really isn't that good of a policy. Well, term insurance is best when you're young and you're healthy because it's so affordable. Okay, any questions on the basics of term insurance I've given you so far? Nope. Okay, perfect. So let's talk about the 3 types of term insurance. The 3 types of term insurance you want to write down. Level term insurance. I'm going to go through these ones individually. Level term insurance. Remember when I said the word level? That describes the premium and the face amount. That means if you buy a $500,000 term policy, it will stay the same price and it will stay the same coverage amount for the duration of that time period. So if you get a 20-year or 30-year or 35-year term policy, you can expect those premiums to stay the same and the death benefit to stay the same. Level term insurance is the most common type of protection. Write that down. Level term insurance is the most common type of insurance that is sold when it comes to term. And that's all you need to know about level term. Any questions on this? Okay. Let's go through the next one. We're going to call it's called annually renewable term. I'm going to give you the best example how to remember this. Annually renewable term. And next to that, I want you to write the word ART, A-R-T. Because if you see this in the question, and you say, if it starts asking about ART, well, we're going to know annual renewable term insurance. Everything we need to know about this is in the word. It's annually going to renew. And I told you, every time you renew a policy, it's going to go based off of your new age. So we can expect the premium is going to go up every year. So annual renewable term, the coverage renews every year. The premium is going to go up every year. The good thing is you do not have to requalify medically. So if you ever see on the exam, what is the most cost-effective insurance? What you're going to think is level term insurance. No, it's actual annual renewable term insurance. Annual renewable term insurance is the cheapest, the most cost-effective, because it just renews every year. If you don't want to keep it, cancel it. The problem with annual renewable term insurance is because it gets more expensive every year. We always like to use this example. Let's just say you're 85 years old. Annual renewable term insurance is going to be expensive. And if you guys know good old Uncle Murphy, Murphy's Law, anything can go wrong, will go wrong. If you've ever heard that phrase. If you can't, let's just say you're 85 years old and you have an annually renewable term policy. You cancel it. The moment you cancel, dadgummit, you pass away. So annually renewable term insurance is not going to be the best, in most cases, not the best product for older people, but it is because it's generally more expensive. So let's just recap that again. Annually renewable term insurance goes up every year. You don't requalify medically. It is the most cost-effective policy. And when you renew it, you do not have to provide proof of insurability. You do not have to go through medical questions. And that is all you need to know about annually renewable term insurance. Again, the word ART. let's go through the word decreasing term. So next to the word decreasing term, I want you to write the word mortgage. So in the word decreasing term, we're going to write the word mortgage. Well, why are we writing mortgage? Well, because this is what's different about decreasing term. The face amount goes down every year. So let's just give you an example. Let's just say you got a mortgage and you're going to buy decreasing term to protect the home. That if you, God forbid, pass away, that policy can pay off the house. So let's just say you get a $250,000 policy. It's going to be, and every year your mortgage is going to go down. That death benefit is going to go down. The one thing about decreasing term is that the premium is going to stay level. The premium is going to stay the same the entire time. So for the same $250,000, 10 years later, it might be $180,000. You're still paying the same amount of money. That is decreasing term insurance. That is all you need to know about decreasing term. The premium stays the same. The death benefit goes down every year, and it is meant for a mortgage. Any questions on that? Okay, perfect.
I do have a question.
Yeah.
So it's only going to cover the mortgage. You don't get the remaining portion if the person passes.
Well, no, of course, yeah, you'll get the money. Is depend on how this policy is written.
Okay.
It's meant to cover the mortgage, but at the end of the day, it's your money. You get to decide what you do with the money.
Okay.
So if you say, hey, you say, F it, I don't want this house no more. You can just keep the money and do whatever you want with the property. But yeah, good question though. Let's talk about the next one. It's called return of premium insurance, term insurance. Return of premium, ROP. When you see the word return of premium, I want you to write the word increasing term. And I'll break this stuff down for you, very simple. Some insurance policies, they'll say, listen, if you get a level term policy, it's because you're young, you're going to pay $30 a month for $100,000 of insurance, just for this example, for 35 years. And if you pass away for this level term policy, we're going to give you the $100,000 for the same $30 a month. And if you don't die, well, congratulations, you made it. Your policy expires. That's level term insurance. But then there is a rider or a type of policy that is sold called level term insurance or return of premium insurance. And they say, well, listen, we can add on a rider to this policy. And if you don't die after the 35 years, we're going to give you all the money you paid back into the policy back to you. How does that sound, Ty?
Sounds a lot better than not getting nothing.
Correct. Sounds like a better deal, right? But what if I told you the price was going to double? So instead of paying $30 a month, you're going to pay $60. And then after 35 years, if you're still alive, you're going to get all that money back. So they're going to double the cost.
Sounds like I'm a gambling man.
Well, that's what life insurance is. You're gambling to say, hey, listen, I'm going to pay X amount a month. If I die, you pay my family this. The insurance company says, well, I'm willing to bet you $100,000 that you ain't going to die. That's what life insurance is. Now, the problem with return of premium insurance is that it's significantly higher. So return of premium insurance, as I told you, the word rider. Jetty, you remember what rider meant? It was an add-on to a policy. So the word rider means add-on. You typically won't see this in much of a term policy. You'll see this as a rider for the exam purpose. You'll see the word return of premium insurance as a rider onto a whole life policy. So they're going to give you a portion of your money back. Any questions on this? Nope. Okay, perfect. So last thing we need to know about term insurance. There's something called renewable provisions. The word provision means rights and obligations. So I mentioned this earlier. There are certain options and certain policies that will allow you to renew the policy at, let's just say again, back to you, Ty, you pay the policy for 35 years, you're still alive, you feel like you still need coverage. Well, with the renewable option, they're going to allow you to renew your policy without any evidence of insurability. Make sure you write that down. Renewable. Also, another word for that is called guaranteed renewable. They're going to allow you to renew your policy with no medical questions. Now, I will tell you this. There are companies out there that sell extremely cheap term insurance. And they say, well, listen, come work with us and you can get, come work, be a client of ours, and you can get cheap term insurance. But once the policy expires, they don't have that without evidence of insurability. You have to requalify medically. And we know in 30 years, your health can change dramatically, right? So what some companies do is, since we know you're going to have to requalify medically, we're going to give you the convertible option. We're going to say, hey, listen, you have term insurance. Let's just convert it to a permanent policy without evidence of insurability. And this example, you are going to convert your policy. Now, guess what? Anytime you renew your policy or you convert your policy, your premium is going to go up because it is now at a new age. So anytime you increase your coverage or you make changes to your policy as far as converting it or renewing it, understand your premiums are going to go up. Any questions on term insurance? Okay, perfect, good. So that's the first type of insurance. The second one is going to be called permanent insurance. So there's three things I want you to, three or four things that I want you to write down about whole life insurance. Whole life insurance has a few things that we need to know. These are the skeletons of every life insurance policy. They are called permanent policies. Remember, term insurance was temporary, whole life is permanent. They mature at 100 years old. So what does that mean, you mature at 100? Let's just say you have a $100,000 whole life policy. If you live to 100, they're going to say, congratulations, we're going to give you your death benefit to the person that's alive. I think that's a win. I mean, imagine you're 100 years old, you're like, I paid in this policy for so long, I now have 100 grand. What you gonna do with it? I don't know. But that's what happens. And then a whole life policy has cash value. I need you to make sure you know that whole life insurance has cash value. Whole life insurance with the cash value has living benefits. And they have a guaranteed death benefit. Guaranteed death benefit. These are that is the skeleton of whole life insurance. Every whole life insurance policy has all these features. They might change in between, but those are the skeletons we need to know, okay? So let's go into whole life insurance. Just like term insurance, the premiums are leveled based off of the age you get the policy, unless the policy is not designed that way. And I'll go through those ones in a little bit. The death benefit is guaranteed and also remains level for life. So just like term insurance, a level policy, the benefit and the premiums are going to stay the same throughout the duration of the policy. The cash value is created to accumulate the premiums for a portion of that to go towards the death benefit and the cash value. So out of all premiums paid into a whole life policy, a portion of it goes to the cost of insurance, and a portion of that is credited to the cash value. Living benefits. This is where you guys see on TikTok and Instagram where people talk about using life insurance as a savings vehicle, okay? This is where the policy owner can borrow money from the cash value and they can receive the money for whatever they want to use. So the cash value, also called non-forfeiture options, non-forfeiture values, you're going to see this word. Just put those and highlight that those two are like hand in hand. Cash value, non-forfeiture options go hand in hand. The cash value does not accumulate until the third year. So Stephanie, what does that mean? You're going to, let's just say you have a $200 a month policy. You're going to put in $200 a month for the first 3 years. Your balance is going to be zero. Does that sound like a good savings account? It does. If you put, I don't know about you, Stephanie. If I put money into an account for 3 years and it's zero, those are fighting words are there. I want my money. So just make sure we understand that. And then the money grows tax deferred. I'm going to break this whole life insurance stuff down for you where you're not going to be fooled or lied to from these life insurance people. Whole life grows, the cash value grows tax deferred. Just make sure you write that. Cash value grows tax deferred. All right. Any questions on the basics of whole life insurance just yet?
I do have a question.
Yes.
So you said that it goes to 100. What happens if you live past 100?
So I've seen policies written to like 121, but for the sake of the exam, it's going to mature at 100 years old.
What? So my grandmother turns 96 this month. And now when you said that, I'm like, I wonder, so now what happens? Like, I mean, I don't expect to live to 100, but clearly we live in a long time in my family. So she's 96. So like that, she won't have insurance after that, or?
We should look into that policy for your grandma.
Okay.
That one's put that down. Training note. No, let's go to friggin'. I need to come up to Atlanta, hang out with you guys some more. But yeah, good question.
Okay.
Does somebody else have a question? Harjeet, did you?
I have a question. Yes, I'm sorry to interrupt, but so you said the cash value grows tax deferred. Could you maybe explain that a little more?
I'm going to go into detail. Yeah. I'm going to do a whole breakdown on this.
Okay.
I just need you to know the basic definitions of this. I'll break all this down for you.
Okay, got it.
Okay, so let's go through ordinary whole life insurance. So I want you to write these 3 words. Ordinary whole life, traditional whole life, straight whole life. Ordinary, traditional, straight whole life. These words all mean the exact same thing. And the way I just described whole life insurance, it matures at 100, your premiums are leveled, the death benefit is leveled, and it grows a cash value. That is the definition of ordinary whole life insurance. So everything I just explained about whole life insurance up here, that is the definition of ordinary, traditional, straight whole life. So if you read right here, of common whole life policies, straight whole life is the lowest annual premium. So remember how we were talking about annual renewable term insurance is the most cost-effective term? Straight whole life is going to be your most cost-effective whole life policy. Perfect. Any questions on this? Nope. Okay. So let's talk about limited pay life. So when you write the word limited pay, I want you to write two specific versions of this. It's 20-year pay and then life at 65. So you're going to see the word 20-year pay and life at 65. As literally says life at 65 and 20-year pay. These are your limited pay life. So what does 20-year pay mean? That means you're going to pay for 20 years and the policy's paid up for the rest of your life. And then when you see the word life paid at 65, that means you pay until 65 years old and then your policy's paid up. That's pretty straightforward. Now, let's think about this. That means you're condensing years of premiums into a shorter period of time. So your premium is going to be a lot more expensive. Your premiums are going to be higher, but your cash value is going to build faster. The reason it's going to grow faster is because you're going to be overfunding the policy. Okay, any questions on that? Nope. Okay, let's talk about the next one. It's called single premium whole life. When you see the word single premium, I want you to write the word lump sum. Think of the word lump sum. Every time I hear lump sum, I think of that commercial J.G. Whitworth, 877 cash now, 877 cash now. Because they talk about lump sums. When you are taking a lump sum, Nat, what's going to happen is you're overfunding the policy up front. So you're putting in, I've seen examples of where people say, put $100,000 into a whole life policy, and then you can start borrowing 80% of the money in the account right away. Well, of course you can. You put 100 grand into a policy. So the one thing about single premium whole life is the cash value generates immediately. Every other whole life policy was 3 years for it to generate cash value. This one is that it generates immediately because you're overfunding it. And just for the sake of the test, I don't know if that means single premium, meaning you only pay one lump sum for the whole life, or you're paying a lump sum for the year. So you can break this thing down into multiple ways. I always say, okay, they're paying for the lifespan of the policy, but it really doesn't go into detail for the exam. Any questions on this? Okay, so if we were to look at the differences of whole life and term insurance, I like this breakdown right here. The differences between term is temporary, whole life, permanent until age 100. The premiums are leveled. Whole life premiums are leveled. The death benefit for term insurance, because you have decreasing term or increasing term, the premiums can the death benefit can vary. Whole life insurance, death benefit obviously stays the same. Living benefits not available. For the exam, you see that, but that's not true for term insurance. There are term policies that have living benefits in the real life, but for the exam, just think, okay, no living benefits. And when they say living benefits, they're referring to what is called the cash value. Remember that, Stephanie? And then whole life, obviously, living benefits, cash value, policy loans, non-forfeiture values. Any questions on whole life insurance? On traditional whole life? Nope. Perfect. So let's go on to the third part. Now, this is where whole life insurance gets very confusing. But we're going to simplify it, okay? These type of policies, I think there's only 3 or 4 ones we're going to look at. Yeah, it's probably 3 or 4 ones we're going to look at. So write the word adjustable life. Adjustable life is a combination of term insurance and permanent insurance. Don't let that confuse you. we're gonna keep this simple. When they write an adjustable policy, it gives you the flexibility of term insurance with some of the benefits of whole life insurance. So I want you to write next to adjustable life. You choose 2, insurance company chooses 1. So you choose 2, insurance company chooses 1. What is that describing? That's going to describe the benefits of how you lay out the policy. So when you as a policy owner, there's 3 things that you have to take into effect: the death benefits, the amount of money you're going to pay, and the duration of the policy. How long is the policy going to last? So as the client, the policy owner, you get to decide. Now, let's just give you an example. Let's just say you say, I want a 30-year policy and I want 100 grand. Well, those are the 2 options you're choosing. They're going to choose the premium, what you're going to pay. Well, let's just say, Jetty, it was the other way around. Let's just say I want to pay $50 a month. Well, guess what? They're going to give you the options. You want you $50 a month, and I want to have it for this long. Well, this is how much death benefit you can get for what you want to pay. Does that make sense? So what are the options? So increase or decrease the premium on the policy. You can increase or decrease the face amount, and you can change the period of protection. The policy also allows you the option of converting from term to whole life or vice versa. However, increases in the death benefit or changing to a lower premium policy usually requires proof of insurability. You want to write that down. If you convert on the policy to anything, if you change these things throughout the policy, it's going to require you to provide medical. Either you're going to have to do a medical exam or you're going to have to re-answer the medical questions. In the case of converting from a whole life to a term, the insurer may adjust the death benefit. The policy owner may also pay additional premiums above and beyond what is required under the permanent form in order to accumulate greater forms of cash value or shorten the premium, paying the premium. What does that mean in real life? When you are paying more premiums, you're going to pay up, you're going to build a cash value faster, but you also have the ability of paying the policy up faster. It's like if you were to overpay your car insurance, you think the insurance company is going to deny your money and say, no, hold on. I wouldn't want your money right now. Wait. No, they're going to take your premiums all day long. Although adjustable life policies contain the most common features of whole life, the cash value on adjustable life policies only develop when the premiums are paid, when the premiums paid are more than the cost of insurance. So in this example, this says the cash value on an adjustable policy is only going to grow if you overfund the policy. Think about that. You bought a policy because you want to build some savings. Well, they're literally just going to say, hey, unless you overpay into this, Sebastian, you ain't going to have no cash value. Any questions on adjustable life? Feel free to chime in.
Is that an example of, like, say you had a term policy since they let you convert it, so maybe they want to convert it and not have to do the other one? So is that like an example of why somebody would do adjustable?
Why someone would do adjustable, I don't know, honestly. These are rare. I don't see adjustable life policies in the field very often.
Okay.
All the testing you hear is on the features of the policy, just understanding of it.
Okay.
But adjustable policy is a whole life policy. It's not a term policy. They just allow you to convert back and forth to one or the other. So yeah. So it really doesn't answer your question, but just for the sake of the exam, that's what you need to know. Okay, this one right here is going to get a little bit deep. I want you to write this one down. Universal life insurance. Another word for this is called UL. These are sold heavy these days. These policies were introduced to the marketplace in the 80s. Universal life insurance, another name for this, Kimberly, is flexible adjustable life. Flexible premium adjustable life. This is to say that the policy has flexibility, so you can go up and down in your coverage and all that fun stuff. But let's just break down the skeleton. When you see the word universal life, I want you to write the word annually renewable term plus cash value. So under universal life, write the word ART, annual renewable term, plus cash value. So what does that mean? If we break down the definition of annual renewable term, remember the cost of insurance goes up every year. You don't have to provide proof of insurability, but it does renew every year. So in a UL policy, your cost of insurance is going to go up every year. Plus you're building a savings portion in the life insurance policy. And a universal life insurance policy, they have two types of premiums. I want you to write this down. Write standard premium and then target premium. We're going to come back and I'm just giving you the definition of things you need to know. Standard premium, target premium. The standard premium is just your minimum. No, it's minimum premium, not standard premium. It's called minimum premium. This is the amount of money, Stephanie, that you need to keep the policy in force so it doesn't lapse. Let's just say you have $100,000 universal life policy and your minimum payment is $50 a month. But they say we're going to also give you a target premium. Target premium, Kimberly, is the amount that they recommend you pay. You overpay to keep up with the cost of insurance. So the target premium is generally going to be, let's say, double or triple the recommended amount. So if your minimum payment is $50 a month, your target premium is going to be $150. Well, why do they want you to pay $150? Because I said annual renewable term insurance goes up, the universal life policy premiums are going to go up every year. So after 30 years or 35 years of paying into this, you're going to see that if you didn't keep the target premium up, they're going to eat the cash value to pay the premiums to keep it in force. So they're going to take the money out of your savings to keep paying the new premiums. So what happens, Katya, is once that cash value is reached zero, they're going to send you a bill in the mail and say, hey, listen, this is your new premium. You don't have no more savings in your cash value to keep paying this. And what happens, Katya, if a family can't afford to pay the new premiums? What happens to the policy?
It's going to lapse.
It's going to lapse. Well, guess what, guys? That is what's happening right now in the marketplace. Universal life insurance is set up the exact same way I told you. That's one of the biggest portions you need to know about universal life insurance. So as you're going back and to rewatch this, pay attention to the stuff that I'm saying. I know I'm going through this stuff very fast, but that's very important. So let's go back over here about annual renewable term insurance. I'm sorry, universal life. This policy allows you to skip a payment without lapsing the policy as long as there's sufficient cash value to cover the monthly deduction and cost of insurance, which is just what I said. You can skip a payment, or if your cost of insurance, they're going to drain it from your savings to pay that payment. If the cash value is too small, the policy will expire. Does that sound like a good idea, Stephanie? Sound like a good investment? Good savings option? Who am I to judge? There are some people that watch this that actually believe in whole life insurance. Okay, let's talk about this, guys. And universal life, this is where sometimes people get confused. There's two options of how the death benefit will pay out. I want you to write the word option 1 or option A, mean the exact same thing. Option 1 or option A, and then option B or option 2. Those mean the exact same thing. So A and 1, same thing. B and 2, same thing. Option A, if your family passes away, I'm sorry, Kate, if I can use you as an example again, let's just say you and I have a life insurance policy for a client. They have the life insurance and they have the cash value. The family is paying for 2 products, but they bundle it together. That's what whole life insurance is. The family is going to get the death benefit because that's what the policy says. What do you think happens to the cash value?
Does it go down?
Well, who do you think gets the cash value? The insured passed away, so their family gets the death benefit. But where do you think the cash value goes?
To the family. So is that the same?
It should go to the family, right?
Insurance company.
It actually goes to it actually forfeits back to the insurance company.
Oh, wow.
So remember this, guys, in whole life insurance, you're paying for life insurance and savings. If the family passes away, the insured passes away, the family receives the death benefit and the cash value is forfeited back to the insurance company. That is the skeleton of all whole life insurance, except for this next one I'm going to give you. Remember how I said option 2 and option B? That is the only example of where the family receives the life insurance and the death benefit. So when we come over here to option 2, that is when the family receives the death benefit and the cash value. And next to that, in your little realm of where you're writing things down, write the most expensive one. And before I miss this, guys, forgive me. On option A, you're going to see a question. You're going to see a word in the question. Let's see where I find it in here. If I don't see it here, write it down. I want you to write the word corridor right here. There we go. The word corridor. corridor. I can take this to the bank. If you see the word corridor in the question, it is option A. Don't even second guess it. If you say in such and such example, and you see the word corridor, if you see the word option A or option 1, click on it, move on to the next question. You got it right. What does the word corridor mean? Guess what? They give you a bunch of stuff right here. I can explain it, but I'm just giving you the skeletons of what you need to know to pass this exam. So under option A, the death benefit is level. Perfect, wonderful. Option B, it increases. The family gets the life insurance and the death benefit. That's all you need to know about option 1 and 2, or option A and B. That's all you need to know. Okay, let's talk about the next piece. Variable whole life insurance, okay? This is when things can get very confusing. I want to break down the word variable. Variable life insurance, remember, so whenever you see the word variable, as the agent, you must have your life insurance and your investment license to sell this. And when you see the word variable, the policy owner is going to be the one that takes the risk. The policy owner takes the risk because it's riskier. I got a whole thing I'll break down here for variable here in a second. So let's just talk about this. Variable insurance, sometimes referred as variable whole life, is a level fixed premium investment-based product. So if we were to look at this, like traditional whole life insurance, these policies have a fixed premium and a guaranteed minimum death benefit. The cash value of the policy, however, is not guaranteed. So for the skeleton of a variable life insurance policy, you can write that as fixed premiums and a guaranteed minimum death benefit. The cash value is not guaranteed, and the cash value is going to fluctuate based off of whatever the market does. So the cash values actually has a possibility to grow a lot higher, actually, because you're in the market. Okay, so the cash value of the policy, however, is not guaranteed and fluctuate. No, the cash value of the policy is not guaranteed and fluctuates with the performance of the portfolio in which the minimums have been invested by the insurer. The policy owner bears the risk in the variable contracts. When you put your money into a policy, because in a life insurance policy, they're combining the life insurance and the savings, life insurance companies will put your money and their money together and they put it into a general account. So they keep their money together. But if you say, hey, listen, I want a variable policy, well, they say, well, all right, take your ass over there and we're going to separate our money. We're going to put you in a separate account, okay? So variable, I want you to write the word separate account. They say, hey, take your money over there. Congratulations if you do well, but we ain't taking that risk. So again, I'll break this stuff down here in a second. Any questions on variable? Nope. Let's talk about variable universal. If it wasn't more confusing with adjustable, universal, variable, let's add a variable universal. Don't let this stuff overwhelm you guys. Again, once you get the skeleton of this stuff becomes very simple. This one, you really don't see a lot of these in the marketplace. You're probably dealing with a higher net worth person if you see these policies. This is not your standard policy buying these, or a standard customer buying these. So variable universal is a type of policy that combines many features of whole life with flexible premiums of universal and the investment component of variable life, making it a securities version of variable universal. Again, back to variable. You must have your life insurance license. You must have your life insurance license to sell this. So your Series 6 and your life insurance. So variable universal life, like universal itself, has the following features. Flexible premium, so you can go up and down in premium. It can be skipped if there's enough cash value. It increases or decreases the amount of insurance. So you can choose to go up and down in your coverage. And then the cash value on policy withdrawals. Standard stuff about whole life insurance that we already covered. It's just that you can skip the payment sometimes if you have enough money in the savings. You can choose to go up and down in your coverage if you need to, and then that you can borrow from it. The most important piece you need to know about this, when you have your investment license, you are regulated by FINRA, the SEC, Securities Exchange Commission, and FINRA, the Financial Industry Regulatory Authority. If you see this in the question, if you see anything variable universal or variable life insurance, they are regulated by these right here. Variable life insurance is also regulated by the insurance department because it is now an securities product, but it's also an insurance product. Let's talk about this. Agents selling variable life products must be registered with FINRA. You want to write this down. Agents selling variable must be registered with FINRA, must be licensed by the state to sell insurance, and have received a securities license. Okay, any questions on variable universal life? Okay, let's go down to the next one. Interest sensitive whole life, also referred to as current assumption, is a whole life policy that provides a guaranteed death benefit. So again, interest sensitive has guaranteed death benefit at 100. The insurer sets the initial premium based off the current assumption that about risk, interest, and expense. If the actual values change, the company will lower or raise the premiums in designated intervals. In addition, interest sensitive whole life credits the cash value with current interest rates that usually are comparable to money market rates and can be higher than the guaranteed levels. The policy provides for a minimum guaranteed interest rate. Interest sensitive whole life provides the same benefits of traditional whole life with added benefits of current interest rates, so which may allow either the greater cash value or shorter premium term. Let's just simplify this. It works like regular whole life insurance. But if interest rates are high, like right now, our market is what? I think it's 8% on a mortgage these days, right? Interest rates are high as hell these days. That's going to give you, and the banks are giving you higher interest rates, and this account, your cash value is going to grow a little bit higher. Don't overwhelm yourself in that one little subject. You might see one, maybe two questions on the exam. Don't overwhelm yourself with that. Any questions on this though? Okay. Last type of whole life insurance, indexed whole life insurance. When you see the word index, I want you to write the word equity. I want you to write the word stock market. Write the word S&P 500. Indexed means equity, S&P 500, stock market. Does that mean the index is invested in the stock market? No, but I'm going to just help you understand these words. Index whole life policies, what they do is they mirror. They don't actually invest in the S&P 500. They just find an account that is performing very similar to it, and they're going to invest your cash value into that. They do give you a guaranteed minimum interest rate. So write that down. If you are quizzed on this, you'll see that. Index whole life insurance does have a guaranteed minimum interest rate. The policy's face amount increases annually to keep up with the pace of inflation. So your policy's death benefit, also face amount, same word, can go up if the inflation is going crazy. Again, the market we're living in today, inflation's going through the roof. So without proof of insurability, you can increase your policy. Most of the time, if you are increasing your death benefit or your face amount, you have to provide medical questions. You still have to provide a proof of insurability. Index whole life insurance are classified depending on whether the policy owner or the insurer assumes inflation risk. If the policy owner assumes the risk, the policy premiums will increase and the face amounts. If the insurer assumes the risk, the premium remains level. That means if the market's doing well, your premiums are going to go up. If the policy owner, if you're taking on the risk, the premiums are going to go up. If the insurer, which is the insurance company, the premiums are gonna stay the same. I don't know how they break that down. I don't know how they make sense of that, but for the sake of the exam, that's what we need to know. These are good things to know about adjustable life. These are all the key things you should come back and read. This will give you the breakdown of what I said, but a lot cleaner. Any questions on this? No, no questions? Okay. So let's go to combination plans and variations. I promise you guys, we're almost done with whole life insurance. Yeah, okay. We only have 2 more types of policies. And that first one is called joint life. Joint life, next to that, right, first to die. Joint life is a single policy that is designed to insure 2 or more lives. Joint life policies can be used can be in the form of term or permanent insurance. The premium is joint, would be less than the same type of policy amount of coverage the same individual. So it's more commonly found as joint whole life, which functions similarly to an individual whole life policy with 2 major exceptions. So 2 things we need to know about whole life and joint life. The premium is going to be based off of both the ages of the insured. So you got mom and dad, married couple. We want a policy, and the first one, let's just say they want a joint policy. Hey, if one of us pass away, we want to make sure the house is paid off, or we want to make sure the other one's good. That's going to be called joint life. Really, only 2 things you need to know is that premiums are based off of both each other's age, and it is called the first to die. So whoever the first one to die. You can also use joint life and funding for a buy-sell agreement. How I was telling you guys last night for policies for business owners, you can use this to fund a business deal. Premium rates for joint whole life are determined by the average age of both insured. Last one we need to know is called survivorship life. Second to die. So is much same form as joint life. It insures 2 or more lives. Premium are based on the joint age again. The major difference is it's called survivorship. So the last one to die rather upon the first death, since the death benefit is not paid until the last death, joint life expectancy is extended, resulting in a lower premium that typically is charged for joint life, which pays upon the first death. This type of policy is often used to offset the liability of estate taxes. So that's good to know. And I don't know if y'all know this, in life insurance, if a loved one passes away, that death benefit is tax-free. So you get a check that is tax-free. And I always tell the husbands that the moment they get life insurance, they got to sleep with one eye open. See, Katya, see, I saw your eyes move. You're like, you were just brainstorming right there. You got a brand new baby. Don't do nothing. Good. Any questions on this, guys? All right. I think, let me know when I can move on to the next thing. The last piece is annuities. Annuities gets a little bit deep, but I'm going to simplify that for y'all. Y'all ready? Can I move on to the next one? Good. Nat, I see you writing over there. Am I good to move on? Okay, perfect. Okay. So let's go on to annuities. What is an annuity? First of all, an annuity is an insurance product. An annuity is a contract that is used to liquidate an estate. Like the reason you hear the J.G. Wentworth 877 cash no, 877 cash no. The reason that they are there is they're there to take whatever money you have, to let it grow, and to pay you over a certain period of time. Like if you've ever won the lottery and they give you 2 options, you could take a lump sum which are they already take half the money right off the back, then they tax you on that. Or you could extend the lottery over 20 years of your lifespan. If you guys ever won the lottery, always take the lump sum. Don't take the monthly payments, because there's one time Puerto Rico had a lottery and Puerto Rico went bankrupt. You know, whoever won that lottery, good luck, they didn't get none of the money. So make sure you always take the lump sum. You always end up better on the better side. Nat, if you play the lottery, just tell me, I got you. So I want my like 0.5% finder's fee, right? All right, guys. So annuities. Annuities are generally meant for two types of people. Generally someone who is trying to, there's two types of annuities, and we're going to cover this. You have fixed annuities, which are for your people who are very conservative. They don't want to take any risk, and they just want to somehow get a better return versus what the bank is giving you. So fixed annuities. And then you have your variable annuities, which are, again, your higher risk annuities. Those ones are generally meant for people who have a long span to invest long term. Okay, so let's talk about who enters a contract of an annuity. The owner. This is the person who purchased the contract. It does not have to be the one who receives the benefits. The owner of the annuity has all the rights to the contract, just like the policy owner in a life insurance policy. They control everything. They don't have to be the one that receives the money, but they have full control over it. So the owner of this contract can name the beneficiary. They can even surrender the annuity. Let's just say you bought an annuity for your grandkids, and now they start acting up. They say, nope, taking that away from you. I'm cashing this thing out. Good luck to you guys. So one thing we need to know, the annuity, the owner of the annuity may be a corporation, trust, or a legal entity. If you guys ever, again, today, social media gives you all this tax law about using financial products to build your legacy. Building a trust obviously is important, and you can do that using an annuity. The word annuitant. This is the person who receives the benefits or receives payment. The annuitant is the person whose life expectancy is taken into consideration when the annuity is written. Sometimes you'll see, you'll see on the exam where it'll say, does the beneficiary's life expectancy matter? No. Beneficiary it doesn't matter who the beneficiary is. They have nothing to do with when it comes to writing the contract, but it's an easy question to get right. The annuitant and the contract owner did not have to be the same person. So, Nat, you could buy an annuity for your son in that example. But most often they are. A corporation, trust, or legal entity may be an annuity, but the annuitant must be a natural person. Write that down. The annuitant must be a natural person. A corporation can be the annuity owner, but they can't be the annuitant. And because annuities are based off life expectancy of an annuitant, the annuitant must be a natural person, regardless of who owns the policy. Let's talk about this, Ty, the beneficiary. The person who receives the annuity assets, either the cash value of the cash value or of annuity. If the annuitant dies during the accumulation period, the balance will go to the annuity's beneficiaries, and they will generally get paid whatever's the higher amount. Give you an example. Let's just say you have an annuity on yourself, and you obviously don't make it to retirement. Your beneficiary is going to get whatever money is in the annuity, whether it's the highest amount of money you paid into it or the interest that's earned on it. Whatever's the higher amount is what the beneficiary is going to get. One thing I should let you know, But annuities are long-term products. These are not products you buy for a short period of time. These are meant for long-term. So when you pay into it, you have the owner, the annuity pays out to the annuitant. So let's talk about the accumulation phase versus the annuity phase. So the words you want to write down: accumulation phase, the pay-in period. Those mean the exact same thing. This is the time you are paying your monthly premiums, your monthly payments into the investment account. When you invest your money into this contract, any interest you earn is going to grow tax deferred. Just like your 401k, just like your some of your IRAs, sometimes like the cash value in a whole life policy, it grows tax deferred, which means you do not pay taxes on it right now, but when you pull out of it is when you will pay taxes on it. The annuity period. I want you to write these 4 words down: the annuity period, the annuitization period, the liquidation period, and the payout period. Those all mean the exact same thing. This just means you're now, instead of paying into the annuity, you are going to start receiving money. That's all you need to know about that. Annuity period, annuitization, liquidation, payout period. You say, hey, listen, I paid into this thing. Give me some money now. I want to start enjoying my life. I want to start enjoying some of this money. And again, remember, once you start pulling out of this, you're going to start paying taxes on that money. But let's talk about the time span for an annuity period. The annuity period may last for the lifetime or for a period of time, whatever the amount, however long the money lasts. An annuity is not a product that you're going to use for your whole life or for forever. You're either going to die and keep getting the money, or when you pass away, the money stops. And I'll break that down for you shortly. Any questions on this? Nope. All right, perfect. Let's keep moving. So during the accumulation period, funds are paid into the annuity. During the annuity period, funds are paid out to the annuity, of course. Let's see this. The annuity income is based on annuity income amount is based on the following: how much money did you pay into it? How much has it grown into it? How frequently did you pay money into it? What was the interest rate you earned? And at what age did you start to receive this money? An annuitant whose life expectancy is longer will have smaller income installments. For example, all the factors being a 65-year-old male will have a higher annuity income payments than a 45-year-old male because he is younger, or a 65-year-old female because she is statistically having a longer life expectancy. Let me give you an example of this. I have a friend whose father passed away, and they left him an annuity. His family chose to not start to receive the money immediately. They let that money grow, and they said, okay, as an adult at 21 years old, you will now start to receive installments for the rest of your life as an adult. So this adult will, him and his brother and his mom will receive money for the rest of their lives. Now, they don't get as much money if they decided to have got it as a child. Same example, literally both of these are clients, but two different examples. The other client's dad passed away, but they chose to get the money in an annuity when he was a child. And that annuity cut off when he turned 18. So they were receiving incremental money as the person was a child, but then it cut off at 18. versus if they would have waited till he was 21, 18 or 21, however the policy was written, they would have preferred would still be receiving money. I don't know about y'all, but I think it's depending on everyone's circumstance. I think the adult might prefer to receive the money for the rest of their life versus a little time span of as a child. So shorter life expectancy, higher benefit, longer life expectancy, lower payments. Annuities are purchased for most part to provide supplement retirement income. In addition, they are often purchased to help college funds. Actually, an annuity can be used in any situation that requires steady income streams at some point in the future. Annuities also provide what is known as structured settlements. I'm going to break that down for you. If you understand, as long as you know that annuities are meant for income streams. Types of annuities. Okay. So annuities can be classified in according to how premiums are paid, how premiums are invested, and when and how benefits are paid out. I'm gonna draw something for you guys here shortly. So classifications of annuities: premiums paid versus single or periodic. So based off of how you pay into it is going to tell you how fast the money grows. You remember in single premium, single premium whole life, you paid a lump sum and the cash value grew immediately. Same thing happens in annuity. If you do a single premium annuity, the investment's going to grow a lot faster. Versus if you did periodic payments, you do payments every month or every quarter or half a year or every year. So if you see the word single premium, again, write the word lump sum, periodic payments. Next to the word periodic payment, write the word flexible premium. Because you can do these premiums in as often as you want and in whatever increments you want. Don't let me lose you guys. I know this can be confusing right now. Don't stay with me. So that describes how you could pay into it. You could pay into an annuity through one big payment or multiple payments. Let's talk about the annuitization. How soon can you receive the money? You can only receive the money in two time durations. Write the word immediate annuity. The word immediate annuity. That means you can receive the money within 1 year or less than 12 months. So Sebastian, if you do a single premium immediate annuity, you can receive the money in less than a year. And then if you see the word deferred annuity, it's after a year. If you guys got that, that's all you need to know about that. Somehow I'm going to bring this all back together. Just stay with me. Fixed annuities. You remember how I was telling you fixed annuities? There's fixed and variable. Fixed annuities have a guaranteed minimum interest rate. Fixed annuities, if you're selling these, you only require a life insurance license to sell them. Fixed annuities do not keep up with inflation. That's going to be a key word you're going to see on the exam. Fixed annuities do not keep up with inflation. And fixed annuities are most suitable for elderly. When you see the word suitable, it just means, hey, who's this best fit for? You're not going to put a 65-year-old in a very aggressive account, because what if the market goes down and you lose all that money? It's not a good situation. So fixed annuity, that's what you need to know about that. Okay, back to fixed. The money goes into a general account. So fixed annuity, make sure you put money goes into a general account. Any questions on fixed annuities? Nope. Okay. Let's go to variable. Again, I'm going to break down variable for you. Very simple. Variable, you need your life insurance and your investment license to sell these. It does not have a this does not have a guaranteed interest rate because the market can go up or down. It does keep up with inflation. You're going to start to see that these are complete opposite of each other. The money invested into a variable annuity, the annuitant is taking the risk, so they're putting your money into a separate account. So when you see the word variable, separate account again. And in a variable annuity, you are still regulated by the SEC and FINRA. Okay, here's a cleaner version of what I was just stating to you guys. So if you guys saw this right here, literally, we just made a bar of how this is broken down. Interest rate, guaranteed by insurer, not guaranteed. Underlying investment is safe, conservative. This is more aggressive, not guaranteed. Life insurance license to sell fixed annuities, life plus securities. Expenses are guaranteed, a variable. Of course, expenses are, they're always going to be a fee. Income payment, guaranteed, it's fixed. Over here, variable, not guaranteed. They're not going to guarantee you any type of money you're going to get from that. Any questions on this? Any? Did I go too fast for you guys? You guys with me? Okay. I want to say, okay. We're almost done with this one, guys. I'm going to skim through this and find out the most meat and potatoes of this. All right, so we're almost done here, guys. Let's talk about how do you receive the money? I want you guys to write down an acronym for me. You're going to see an acronym. Was it CLIF? Yeah, it's going to be CLIF. So you're going to write the word CLIF down on like this. So you're going to write CLIFF. So this is going to be the way you're going to write this. And you're going to write the word settlement options. Settlement options, and you're going to write the word CLIF. And this right here is when I'm going to draw something out for you guys here, and we're going to wrap this portion up tonight. You guys with me? You ain't falling asleep on me? Y'all still alive and energetic? Let's go here. How do I make this a co-host? I do forewarn you, my handwriting is not neat. I am not the best drawer. I am not artistic. And I want to draw something for you. This is no, wrong one. This is what you need to know about settlement options and annuities. I'm about to give you everything you need about annuities in one drawing. And you're going to memorize this, by the way. By the end of this course, I'm going to give you a whole cheat sheet to pass the exam. So let's make sure I can draw here. All right, so let's go through settlement options. What does settlement options look like? So you're going to write the word settlement options. Like I said, my handwriting is not the greatest. Look at that. I was told that if your handwriting was dirty, you're going to get rich. So if you guys got neat handwriting, I feel sorry for y'all. Or maybe that's just a justification I tell myself. All right, so let's talk about settlement options. This is when you are annuitizing your contract. You're ready to start receiving. The way you're going to receive your money is cash. And next to that is lump sum. So you're going to start receiving your money in a lump sum. Say, hey, listen, my money's done well. Just give me the cash. I'm ready to bounce. The second one is called life income. When you see the word life income, this is the highest amount paid monthly. And the reason being is you're going to, if you live until 100 years old, you're going to be receiving this amount of money. But what happens if you choose life income, that the moment you pass away, whatever's money is in that account, the insurance company keeps. So let's just say you had a $500,000 annuity, and this paying out a certain amount of money every month. And you said, give me life income. But you pass away 3 years into it. All that family that would have gone to you, the insurance company keeps. Now, again, there's nothing right or wrong about that. It's just that's what that option says. But there is an option that does come with this that you'll see on the exam. It's called life. Oh, if I can draw. What's this thing? Okay. Life income with period certain. So if you see the word period certain, what this says is, let's just say you have a 15-year period and the person passes away 5 years into it. That means there's 10 years left to get paid out. That will get paid to the beneficiary. Now, again, that's going to be an extra cost onto that, but that's what the family would get. I'm just gonna erase this part just for the sake of my space. The I stands for interest only. And in parentheses, I want you to write temp option. It's your temporary option. You're just saying, hey, listen, I want to receive the money. I don't know what I want to do with it. Just pay me the interest. And you're just going to receive the interest in whatever increments you start to receive it in. Anytime they pay you interest, you got to pay taxes on it. Anytime your money makes interest, the government wants their money. And Stephanie, the last two are F, stands for fixed period and fixed amounts. So let's just say someone retires and they say, listen, I want enough money to last me for 20 years. Well, they're going to take whatever money you have, let's just say a couple $100,000, and they're going to spread that out over the next 20 years. And then fixed amount, very simple. Hey, listen, I need $20,000 a year. All right, and they're going to pay that out until the account is empty. Any questions on this? Feel free to speak up. Y'all are good? Okay, let me do the last portion of this, guys. I want to draw how this whole annuity looks on paper. I want you to draw a big old mountain like this. And if you see, it looks like an A, that A stands for Atlanta. No, it doesn't actually stand. It stands for annuity, if you do that. Any Falcons fans on here? Have you got some? No? Jaguar fans? How y'all live in Atlanta? Y'all ain't no Falcons fans. Y'all some, come on. How y'all not be some Falcons fans over here? Leave me by myself. All right, so what does this A stand for? Well, this is the hill that you are investing in the annuity. You are investing money month in, month out. And this is what is called the pay-in period. You guys remember another word for that was called the accumulation phase. You're paying into this annuity and you're just saying, dang, I hope I eventually get to use this money. When you are investing into this, your money is converted to what are called accumulation units. I like to use the word units as shares, just so it's an easy way to think about it. So your money that you bought is called accumulation units. Your money, again, is going to grow tax deferred. So you're not paying taxes on this growth. You're going to pay taxes once you start the withdrawal. Let's just say at some point you got to pull out of this annuity for whatever reason. Generally, if you pull any money or close out of the annuity, there are something called surrender charges, and they are huge. That's the same thing in whole life policy. They have surrender charges that come out of your cash value. But if you ever pull money out of here, the money is going to be taxed based off of LIFO, which stands for the last dollar in is the first dollar out. So the last dollar you put in there is going to be taxed. Man, that's nasty. I swear. I wish AI could just draw this for me, man. Hey, listen, Nat, you find some AI that can show me how to draw this thing. Let's just pull that out, right? All right, so your money is going to go tax deferred. If you decide to pull money out, it's going to be tax LIFO. You remember how I was talking about how to pay into this annuity? I want you guys to draw a line down this center right here, because I'm going to come back to this. Just draw a line down that. I'm going to go to another page in a second. But I want you to draw up at the top of this mountain. It's like, finally, I'm here at retirement. You say, I'm done paying into this thing. I want to start receiving. That is when you start to what is called annuitize. Another word for that is called liquidation phase, the payout period, annuitization phase, annuity period or annuity phase, one of those things. Yeah, it's annuity phase. I'm spelling annuity wrong, I swear. So annuity phase. Remember, all these words mean the exact same thing. You just want your money. And so you have what is called accumulation units. Those are now going to be converted to annuity units. So your shares are now called annuity units. Now your account is going to start going down because now you're starting to receive money, right? How do you start to receive money? Well, that's going to be based off of your settlement options. You follow me on how this stuff ties back together? Any questions on this? Okay. Let me end this and show you why am I drawing this line. I just couldn't fit it on one page. What does that line mean? If I'm just drawing this down, I'm breaking down the time period of how to pay into this. Keep it simple. The two ways I pay into this is flexible premium or single premium. Remember, when I see the word single premium, think of lump sum. So this is how I'm paying into it. How paying in. And this is how soon can you receive money. How soon can you start receiving money? Gosh. So single premium, immediate annuity. Y'all remember when I said immediate annuity was less than 12 months? And then there's single premium deferred annuity, which is after 12 months. So you can have single premium immediate annuity, and you can have single premium deferred annuity. You can only have flexible premium deferred annuity because you have not had enough time for your money to compound to pull out in less than 12 months. So when you guys go back and you're reading and you're listening to this, it'll start to come together once you know vocabulary. And that, my friends, is all you need to know about annuities. Exactly how I wrote that out. If you go through the definitions and you understand this process, that's all you need to know about annuities. Any questions on this, guys? No? Okay, cool. So back about us, huh? Perfect. So let me stop sharing. That right there, guys, that is tonight's chapter. I don't want to go through too much of the quiz tonight because that's a lot of information, and I promise you it's a lot to jump into. But any questions on that so far? Anything you want me to recap? Any concerns? Any comments? I think I'll be so quiet over here. This is how I know y'all Jaguar fans. Y'all be quiet even when you're winning right now. Ty, you freaking represent the vodka for them.
Hey, now.
Uh,
Look, being the Panthers isn't really nothing to talk about, you know.
Listen,
We got quiet till we do business this weekend.
no, I love it. I love it, guys. Again, stay with me for the next 5 more days. Got 4 more days. That's 4 more nights. We're gonna go into Friday, Saturday, Sunday, Thursday, Friday, Saturday, Sunday. I'm investing my time just as much as you guys are investing your time. This, I promise you, we're gonna go through this as many times as we need. The following week, if we need to get together and study together late at nights, I'm more than happy to do that. I want you guys to stay in contact with each other. If you guys know each other, if you don't, maybe say hello to somebody. Say hello to somebody new. If you need a coach, talk to Nat. What's up? But I'm excited, guys. If y'all don't have any questions, I'm going to somehow try to end this recording. Weird. So stop live stream. Okay, that's one good thing to do. Oh, there's the recording button.